Hey guys, Doug the Retirement Guy here. First, I want to thank each and every one of you who have subscribed to the channel, really helping us out there. If you like what we're doing, give us that thumbs up. If you have any comments, like or dislikes, put it down below, hit the comments. If you really want to help the channel, go down in the description, you'll see a Patreon, click on that, join the club. $2, $5, anything will help the channel grow. Most of all, hit that subscribe button. Don't miss any of the videos we have during these trying times. Today, we have a 4 stocks that pays an 8.85 average dividend, and they pay it monthly. And I really think you should have these in your retirement account. Let's get into today's video. The goal of adding to a retirement account is simple. One, you want investments to grow. You want your investments to have an income so that you can live off of. And thirdly, you want to relax and be worry-free. And that's what retirement's all about. So our best stock picks that we have, and we've been working on this because in the troubled times, we wanted more income. We wanted to fix our portfolio as well. So this is what we found. The first stock has a 6% upside and pays an 8.08% yield. And of course, it's going to pay monthly. Our second stock has a 14% upside and pays a 17.12% yield. And again, pays monthly. But man, this is what we're looking for to grow our dividend stocks. The third one is a 5% plus side with a 5.43% growth. And third is our fourth stock is a 15% growth upside and a dividend of 4.8%. This gives us an average of a 10% growth and an 8.85% average yield in dividends. So if this works out and we take $100,000 and roll it into these 4 stocks, we're going to see a $1,500 increase and a $2,000 gain in our dividends. Our second stock gives us the opportunity to get a $3,500 growth, but it's going to pay a secured $4,280 dividend. Third stock, we're looking for growth, $1,250 growth with a dividend of $1,357. And our final one gives us $3,750 in growth and $1,200 in dividends for a total of $10,000 growth and $8,857 a year in dividends from only a $100,000 investment. If this all comes true and we did $1 million into this, simple math, $88,000 of annual income can't be bad with only 4 stocks. Our first stock, Main Street Capital, MAIN is the trigger. This is a BDC. Now it pays the 8.08% yield and does pay monthly. This thing here pays $4.20 a year in dividends. Now, it is a business banking company, which means they are making loans to mid-size and small corporations that are struggling to find loans in today's market. They have over 200 companies that they deal with currently. Now, when you look at their dividend chart, this is what really got me excited originally when I first looked at Maine. For 10 years, our dividend chart shows that they've had a steady increase back to what I call the baseline, increase, baseline about every 6 months. Then they went to just a flat out, and then they had to go to baseline drop off, and they're back to their baseline increase. And when we really dial into it, it's almost like every other month that they're doing this increase, which gives you that $4.20 a year. But you can almost guarantee a 25-cent per month per share payment out of this company. Next, let's take a look at their performance over the past 12 months. And if you can see, everything was holding steady up until November. And this is the first one I saw that in November, when we had the election change, they took off. Main Street did very, very well in the transition between presidencies. And they were doing great all the way up until, honestly, till that mid-March crisis. And then, of course, like every stock we will see in the tariff war, you're going to see a major drop off in April. But what got me excited was look at the gain that they made since April. In 22 days, they're getting right back up to their average number. And their average over 52 weeks is $53.15. Their current price is $52.81. That's only 0.6 of a percentage point below average. So they're getting right back to where they should be. So we turned around and we have experts that we asked and said, what do you think of Main Capital? And they come back and said, first off, dividend safety, A+. They feel that this thing should have a steady growth. Their dividend should be solid. Their yield, A+ across the yield. They're looking at a forward dividend. They say 5.63, which means they're looking at the stock to start climbing again. And so now's the time to buy with that 8.08 yield. The risk return, very, very little risk at all. A for that category. And then the return, they say that there's a 6% target price adjustment coming, that they feel that the price of the stock currently should be up about 6%. So if you take 6%, that's going to put you above the average where we expect. That's going to bring your dividend yield back down to probably that 5 to 6% rate. So everything falls into place across the board. That's why I think now is the time to get back into Main Capital. Our next stock is AGNC Investment Corp. Now this one pays that 17.12% yield, still pays it monthly. Now what's unique about this one, this is still classified as a REIT because they're in the mortgage-backed security system. So these guys are writing mortgages and they're in the high yield mortgages, which are backed by the government. So very secure and safe investments that you're making. Now, when I looked at their 10-year dividend chart, you can see they started off thinking dividends were the way, get interest in the people to get the dividends. Over the past 5 years, since 2020, they've stabilized and they've kept their 12-cent dividend across the board. Okay, so they are continuously paying this dividend on a regular basis. When we look at their stock performance, again, little drop off in November, balanced out. Started the gaining in January, had the March Madness, and then of course the tariffs of April, and they've balanced themselves out at the end. Their average price is $9.83. Their current price of $8.42 means they are 14.3% below average. So this is again a telltale sign that possibly this could be a buy point. Now, when you look at this one, a lot of people will always say, well, it's up, it's down, but it's not coming back. That's why we ask our experts, what do they think? And they came back and said, first off, dividend safety for this account is an A+. They're a $7.6 billion mid-cap company that is going to produce that dividend on a regular basis because they didn't go out and do stuff crazy. They're still paying at 12 cents per month across the board. They said the yield effectiveness, they're right in line. They're figuring at 17.27 forward yield is in the top 15%. It's A+. They're going to get that yield on a regular basis. The next, return of risk. I love this one. It's overrated from sell side. So what they're saying is so many people were saying sell, 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 sell when they're coming back and saying, no, this is a buy, buy, buy. This is a time where you want to buy the stock because you're at the below average, dividend secure, and it's time to make this thing climb, especially if we get the interest rates dialed in the way they're supposed to be. The dividend, if the interest rates just drop a little bit, you will see this thing rocket back to its average for sure, if not higher. Return potential, A+. They said realistically this thing could be a rocket. 22% dividend, they figure. And that's what they're trying to do here is in the last 3 years, how much has this thing's paid its dividend, what's it's doing, and what does it look like in the future? And they said the returns, hands down, A+. This thing is going to get you the returns you want. So it looks like it's a scary stock, but it's one you want to have in your portfolio because it's going to have the rocket ship of growth when the interest rates change a little bit and as the market opens up to new homes and new sales. Our next stock, Realty Income Corp. And this is letter O on the stock market. Now this one pays a 5.3% yield, does still pay monthly. Now here's the unique thing with this one and why I love this stock so much when we did our research. They have 12,300 properties and their capacity and occupancy is at 98.1%. So these guys are building buildings or have buildings and they're filling them. You look at their dividend chart. This is the full stepping stone. They have growth every year in their dividend. So we talked today 5.43% yield, but every year you've gotten a pay raise. The dividend continuously grows and grows and grows over, this is a 10-year chart. Look what they've done. They were just under about 18 cents and they're all the way up to 26.9 cents today, 10 years later. So there's some solid growth into this one. Next, when we look at the bar chart of this one, and this one just gets you even more excited about this. Here's a stock that, yes, in November dropped off. Flat bottom in January. And with the drop off in the tariffs, look what this thing did in the past 22 days. It is a rocket sled getting back to where it's supposed to be and getting back to profitability. The current price of $57.96 is 3.3% higher than their 52-week average. So this stock is really, it's taking the news and it's affected by the news, but then it says what's real. Are we at full capacity? Yes. Are everything getting done well? Are we getting our interest payments? Are we getting our rent payments? And boom, everyone loves the stock and it takes off again. So dividend safety, A+. 51.1% large cap. They are just a solid company. They turn around, A+. 5.53 is their projected forward yield. That's in the top 15 of REITs. Risk, this thing is A+ across the board when you get to the risk return. And the only negative to this whole fund is the returns potential. And that is a 5% target upside. Okay, 5%. That gives it a C. Well, this is a mature, I call it mature company with 12,000 properties. They would have to add additional properties to get the growth that you want to see. And if you just turn around and say, okay, how many more stores are we going to build? How much more are we going to do? This is where it starts to get a little tough for these guys and say, hey, where do we want to take it next? But they're doing right. They're doing good business practice. And O is just going to continue to grow its dividends and it's going to make you money. Our final stock is Stag Industrial. This is a REIT for warehouses. When we started this whole process, we weren't really looking at any particular segment, but the REITs are really starting to show some strong programs, and Stag is one of them. Now, Stag pays a 4.8% dividend yield, again, pays monthly. Now, the unique thing is they have 569 buildings across 41 states. Compare that to O, where they have 12,000 units. These guys are a lot smaller with only 569 units. But again, when we sit down with these guys, they're continuing to grow their dividends each and every year over the past 10 years. So they're doing the right thing. These guys build warehouses and rent these warehouses out. A lot of it is going to the e-commerce businesses. Okay, they're positioning themselves in prime areas where the e-commercers are going to want to be to fulfill orders very quickly to the homeowners. So that's what's happening, that these guys are getting into the specific areas and making it work. Now, the excitement to me comes into this. warehouse space requests 15%. Okay, they're asking for a 15% growth in their buildings just from people and customers that they already have. The other big positive they have is their rent increases are 7 to 10% per year. Now, if you really look at that and say, can a warehouse afford a 7 to 10% growth? Well, the problem is they've positioned themselves directly where you want to be. So if you want to be on Main Street, you want to be within arm's reach of most homes in America, you're going to pay that price. 7 to 10% rent increases means you're going to see increased dividends, and you're going to see increased value of the stock, which is going to change our yield across the board. So this is a win-win situation for the long haul down the road. When we take a look at the financials of STAG, you can see they did not drop off as much in November compared to O. They had a similar program to it. They had the March Madness. They had the April changeover. But you can see they're already getting themselves out. I look at this and say they're behind the schedule. They didn't have as many properties to make the changes and make the fixes that O had. So this is one that we want to make sure that we're into, because right now they're 10.5% below their 52-week average. Their average price is $36.37, and their current price is $32.52. If we take a look at just that alone, we have ourselves a 10% growth potential just from here, just to getting back to the average price. When we look at the professionals, they come back and say the dividend safety is $6.1 billion mid cap, A+ across the board. Their 4.5 forward yield in the top 30%, we got an A for that one. The risk return, again, they're not seeing in the directional price swings, they're not seeing big swings right, left. They're just seeing steady either growth or minor little adjustments as the market changes. A there. They have a 15% plus upside in the pricing of their stock. Now, they rated that a B because it puts them in the mid-20s of REITs. But in a lot of REITs, you got to remember, they're looking at homes and other areas. These guys are looking at just warehouses in specific areas and prime areas to get their customers into the door so they can reach your doorstep with those orders. So overall, very, very strong stock that's on sale. So in summary, our investment growth, have we done that? Sure, we've done that with a 10% growth in our funds. We've also done an 8.8% monthly dividend payout. So right here, guys, you can relax and be worry-free. You're going to get an $8,857 income from a $100,000 investment. As I said earlier, you make that $1 million investment, you're going to get you can live off of $88,000 a year. So I don't suggest you put all your money into one egg. In a one nest egg, I really highly suggest you spread it out. I have a couple different videos shows you that the BDCs were to put money into. This one here, we could almost call it the REITs, but this is for individual stocks. And we also have one for the ETFs where to put money. So we're trying to show you that if you balance your portfolio, you can sit worry-free even with the market drops and even with the market doing what it's doing when you have solid, secure stocks doing what's happening. Guys, this is Doug, the Retirement Guy. I hope you like what we're doing. If you do, give us that thumbs up. Don't miss any of our videos. Hit the subscribe button. And best of all, if you like or dislike anything we're doing, leave a comment. I'll be more than happy to read it and respond right back to you, because everything you do helps grow the channel. We thank you, and we'll see you next time.